up uncovering the next 2008 level economic collapse.
No, that's not true. Feel free to finish watching this post.
They're going to bankrupt the entire American pension system.
Who is going to destroy the United States' $38 trillion pension system? $38 trillion is bigger than America's entire annual GDP of about 32 to 33 trillion.
This time they're doing it again. Bigger investments, bigger risks, same playbook, but they're doing it behind the smokescreen of private equity in bigger numbers.
In the entirety of this post, the only thing I'm going to agree upon fully with this creator is that private equity is pretty evil, and I loathe it as well. But when you say bigger numbers, obviously, because 2008 was 17 years ago, and this economy constantly grows along with inflation. In 2008, almost 17 years ago, our GDP was about $14.7 trillion. Today, that GDP has doubled to $30.33 trillion. If you use the CPI index, it looks like from 2008 to today, prices rose overall by about 50%. If you look at the PC index, it looks like prices rose by about 40 to 45% for that time period. So yes, absolutely, it's going to be happening with higher numbers.
They're creating a bigger bubble than before, and it's not somewhere down the road. It's here, and it's about to pop.
I've been hearing those exact words almost every day since the Federal Reserve drastically rose interest rates in 2022. And I heard it quite frequently from about 2014 to 2018. But continue to listen.
See, for the last month, I've been trying to figure out why these companies that private equity had acquired were failing even though they were still succeeding.
This is one of the things I don't like about private equity. They will take a loan, sometimes quite a risky loan, to buy a successful company, but then they settle that successful company with the very risky loan they used to purchase it. So now a company that's been doing everything right, that just got bought out, is settled with crazy amounts of debt. And a lot of this debt recently that's been purchased over the past few years was bought with very low interest rates. Unfortunately, these loans were adjustable rates. They were not fixed. And what happens to adjustable rate loans when interest rates start skyrocketing? Yeah, those loan payments start skyrocketing as well. All of a sudden, these businesses that were paying maybe 1.5% or 2% interest rates started having to pay 7%, maybe higher. And you get the rest. A lot of these businesses started becoming bankrupt. Now, the banks, once they provided these risky loans to the private equity firms, began to sell those loans as debt or bonds or collateralized loan obligations. And of course, the loans that these banks patched up, prettied up, and sold to other companies were bought by several institutions, including a lot of American pension firms. So when that business that was purchased by the private equity firm with the risky loan, when they go out of business, the pension fund or the other institution that was holding on to that debt sees the value turn to nothing. Yeah, that's pretty bad. Like I said, this is something that Tiffany and I agree on 100%. But just keep watching.
In the last few years, private equity has taken out $3.8 trillion in adjustable rate loans.
Now, I spent quite some time looking for that $3.8 trillion figure, and I couldn't find it anywhere. The closest I could find were from Eaton Vance, and they say the total number is $1.4 trillion. Other sources say it's close to $1.6 trillion. And that $1.4 or $1.6 trillion is the entire adjustable rate loan market. Private equity is just a part of it, maybe more than half. The best estimate I could find was maybe $700 billion. But let's just say that 100% of that $1.4 or $1.6 trillion is from private equity loans. Now, the only source I was able to find online for that $3.8 trillion figure was from somebody called Tiffany Chiang. But guess who that is? And it was interesting because it says Tiffany Chiang, known as the Vino Mom. So naturally, I decided to look up on Google, who is this Vino Mom? Oh, first I looked up Tiffany Chiang, but she's a cook influencer. She doesn't talk about finance or economics. So then I just looked up the Vino Mom, and I mean, this girl looks pretty familiar over here. Is that you? Is it? I mean, did they just mess up your name and make you sound like an Asian person? Now, like I said, everywhere I looked, I could only find between $1.4 to $1.6 trillion as the total amount of adjustable rate loans outstanding for private equity. And that debt that was sold by the banks to these pensions and other institutions, they're called CLOs, that totals maybe $900 billion to $1 trillion of that total loan market.
Right now, private equity, that's the yellow section, has double the highest number of bankruptcies they'd ever had prior to last year. And that number is climbing this year.
It is not just because private equity companies are evil that these bankruptcies were skyrocketing. When the Federal Reserve started raising interest rates very quickly, it took time for a lot of these companies to crumble because some of them were able to last maybe 6 months, some of them were able to last a year, some of them were able to last maybe a year and a half. And it wasn't just companies that were bought by private equity that went bankrupt. The overall bankruptcy rate increased when the Fed raised interest rates. This is the bankruptcy rate in the United States. And you could see during COVID, that huge drop in bankruptcies was because the government heavily intervened. But when the Fed started raising interest rates again, bankruptcies went back up to their normal level. So bankruptcies haven't been skyrocketing. They've actually just reached their normal level, which has been a 30 or 40-year low.
$3.8 trillion.
1.4 trillion.
$3.8 trillion in this debt.
Maybe 1.6 trillion, but definitely not 3.8.
Look back to 2008. Do you want to know how many risky adjustable rate mortgages there were? $1.1 trillion.
In 2008, the entire mortgage and mortgage asset market was about $14.47 trillion. Now that includes mortgage and mortgage-backed securities and other mortgage-based assets. And 33% of those mortgages were adjustable rates, so about $4.9 trillion.
Do you want to know how many subprime but not quite as bad loans there were? $1.3 trillion.
Now, she's right. $1.3 trillion was the total amount of subprime mortgages in this country. But 80% of those subprime mortgages were adjustable rate. And maybe that's where she got that 1.1 trillion figure, because 80% of $1.3 trillion is 1.04 trillion, kind of close. But she makes a very big mistake because she doesn't give any reference for that $1.3 trillion. Let me help. That $1.3 trillion of subprime mortgages was about 8.8% of the total mortgage market. And that $1.6 trillion of adjustable rate loans currently held by private equity, that's a percentage of what? All loans or just mortgages? If you want just mortgages, then that is about 7.6% of all mortgages. So it's less than the 1.3 trillion that you mentioned earlier. And the creator makes the assumption that the subprime loan quality of 2008 is the same quality as these private equity loans in 2024, 2025. And she doesn't know that. For all we know, the private equity loans are much safer. We can't prove that, but you can't make the assumption that they're worse or at the same quality of these subprime loans.
In the $3.8 trillion held by private equity, they own the largest shares of the home ownership market in the United States.
No, that's BS. Out of the total single-family housing stock, the 105 million homes that are out there, they own about 0.5%. But if you add Blackstone, it's 0.56%. So not even 1%. Now, I'm a little confused because in the beginning of the post, the creator said that $3.8 trillion is held by private equity as debt, and that's what's been bankrupting all these businesses. But now she's saying that they have this $3.8 trillion of what? Of assets, because she goes off to say how they own all the houses and all the daycare centers and all these things. Even though private equity doesn't have such a big foothold on the housing market, it's true. They are gobbling up the share of doctors, of daycare, all these things, and it's freaking evil. There should be legislation that stops them.
We will never allow the banks to be bailed out again. We would literally riot in the streets. But we're definitely going to allow them to bail out the pensions because that's our grandparents. That's our parents. That's the working class.
I'm not sure if you noticed, but our president has a cult-like following, and the majority of people who voted still support him vehemently. So if there is some kind of financial catastrophe, he just has to go on TV, on social media, and say, hey, we are having a big problem. We have to bail out the banks. And more than half of the country will gladly support him because they take what he says as gospel. And what do you think we got in 2020? The banks, the corporations, they all got bailouts. But they got bailouts without anything completely failing. They got bailouts just in case. And look how everyone responded. They were fine because they got stimulus checks too. So no, if there was some kind of catastrophe that occurred maybe because of the tariffs or some other poor policy decision, the people would just wait to be told what to do, and the people who would be a little angry and may want to cause some kind of blood on the streets, they'd probably stay home because they'd be getting that nice stimulus check. You're getting melodramatic about the pension system again, you know, the one that's $38 trillion. And you're mentioning how the private equity firms are hijacking the pension funds and they're going to destroy our grandparents or our parents or just much older people who've been working their whole lives. And you mentioned that $3.8 trillion again, which I can't find anywhere else online aside from articles about you. So now we're going back to it being bad debt that's been issued by banks that was supplied to private equity. And remember, it's most likely not $3.8 trillion because I can't find that number anywhere. It is most likely 1.4 or $1.6 trillion. So that is about 5% of the total pension market. And remember, of that 1.4 trillion or 1.6, only 1 trillion is composed of CLOs, the collateralized loan obligations. And you're also assuming that 100% of those CLOs have made it into the US pension system. So that maybe $1 trillion of CLOs make up about 2.6% of the entire pension market. But only 6.6% of these collateralized loan obligations are in the pension funds. So we're talking $66 billion. $66 billion is not even 1% of the US pension market, which is again $38 trillion. So no, the collateralized loan obligations from private equity are not going to destroy the entire pension system. Get that out of your head.
One by one, they're going to fall under the weight of this really horrible adjustable rate debt.
But the Federal Reserve has dropped interest rates twice over the past 6 months from 5.5 to 4.5%. And when that happens, every interest rate starts to drop, including adjustable rate loans. The Federal Reserve said that they may drop interest rates as early as June. And if these interest rates keep dropping, so will the payments for these adjustable rate loans. So no, there is nowhere near enough evidence to suggest that these adjustable rate loan rates will keep going up and crush all of these people.
And nobody is talking about it. I could only find 2 articles in very obscure financial magazines.
Nobody talks about it because the collateralized loans in the pension system isn't even 1% of it. Now, those 2 articles that you found from very obscure sources, please share them because I couldn't find any of your sources in the articles written about Tiffany Chiang and that 3.8 trillion bucks.
We're not without any hope at all. Right now, private equity is only allowed to be this exploitative because they exist under something called the carried interest loophole, something that multiple Congresses have tried to close, but private equity continues to bribe politicians.
No, private equity is able to gain a lot of influence and power because of the same reason that the top 1% and a bunch of other corporations do, because we are in a system that favors the wealthy and alters its laws to benefit the wealthy. And just to be clear, Obama in 2015 tried to close the private equity carried interest loophole and it was shot down by a Republican Congress. All our current president did in his first term for the carried interest tax loophole to be shut down was to extend the amount you had to hold it for 3 years in order to qualify for the lower capital gains tax. That was considered not even a compromise. Biden in 2022 also pushed to have the carried interest tax loophole closed down, but that was shot down by a Republican Congress.
Trump, 3 weeks ago, said he wanted to close the carried interest loophole. I thought he was doing it as a fundraising maneuver.
Now our current president is carrying out the same lip service in eliminating that loophole, but he's not going to do that because he keeps making money from it, so does his family, so do his friends. This president guaranteed about $170 billion a year of tax cuts to the wealthy and the corporations since 2017. He's promised to extend and enlarge these tax cuts, so why on earth would he all of a sudden put a corporate gains tax on said wealth? I want to thank you for watching the entirety of this post, and the reason why it was so long is because so many people were DMing me in a panic to see if this was true, and it wasn't. Remember, I am many things, and one of them is the dispeller of fearmongers, and this post that I'm talking about was fearmongering 100%. I am the Geo Husar, and never allow your site to be clouded by a deluge of fearful misinformation. Fact check her post, fact check my post, double check, triple check. Thanks for watching. If you find the post I just made useful, educational, informative, please feel free to subscribe to my YouTube, but the strongest form of support that you can give me would be signing up for my Patreon. Thanks.